I read a note that you flicked over. You'd written a few years ago, and you really highlighted the barriers to entry across the whole rare earth complex.
So the barriers to entry couldn't be any more stark in this. It's almost like something out of Lord of the Rings and the Battle of Mordor. You've just got a massive barrier, massive moat, enormous castle turrets separating pretty much any junior from actually entering into the market. You need at least $1.5 billion Australian dollars and 10 years to get this over, to get a project up and running. And there is little to no guarantee of success in a lot of those instances. Mountain Pass failed after 1.6 billion being sunk into it in 6 years. Lynas was 10 years till it was actually economically profitable.
Money Miners, g'day. Wednesday, 30th of August.
G'day, Matty. How are you?
Oh, mate, I'm bloody excited because the Rare Earth Spectacular is finally here.
We've alluded to this for a while. You know what I was impressed with? All the money miners actually given us some info, some questions.
Research as well.
Yeah, we had
super helpful.
Sector research forwarded to us. Good on you, money miners. This is I love the crowdsourcing of information.
I love the fact that the money miners and anyone else just tells me shit and it just helps me.
It's awesome.
I'll just say it as my own ideas. It's great. Everyone out there, you all know who you are.
Legend.
I really appreciate it.
It's really awesome.
Mate,
So you
chat with Dylan Kelly from Terra Capital. He's a research analyst there.
He's got
a hyper guru for rare earths.
Yeah, he's got an engineering as well as equity research background. He's been in the equity research space for over 10 years before joining Terra earlier this year. So like you sort of touched on there, Matty, we were super interested to do this conversation just to learn from our own point of view. And I took heaps from this conversation. So I'm sure the money miners will get stacks from it as well.
Well, when you say, JD, that you can't wait to listen back to it to take it all in, I know that I'm going to probably have to listen to it 4 times. But it was absolute. This is an absolutely ripping chat about the whole rare earths thematic, clays versus carbonatites, who the big players are, who's good, and we didn't go too much into who's not good.
Well, yeah. But importantly, it's a no bullshit kind of angle that he has. It's not like, DK's view isn't like, oh, it's all fucking good. It was like, this stuff is really freaking hard. There's a very specific criteria of what makes something investable and good. Yeah. This is the criteria I think it is. These are the names that are interesting to me.
And the one big thing I took out of what he said is backing the incumbents.
Because the barriers to entry is so high.
Yeah.
That's it. It's a very, very tough and lengthy processing sort of steps that you've got to kind of jump through to get to the end. So that really speaks to what you said, Matty.
And I reckon the money miners are very keen to hear our thoughts on the Chalice scoping study. That stocks off, was it 20 odd?
25%.
Today.
Very bullish predictions on the palladium price.
And the 29 Metals capital raising, I believe their financial year results are out today, but they're also in trading halt for an entitlements issue that's underwritten. We're going to have to talk about both of those things tomorrow.
Yeah, no, we don't want to take the limelight away from DK, but Money Miners, we will deliver them on Thursday's episode. Can't wait.
Before we do, Matty, we've got a couple sponsors to thank.
And one sponsor that is dear to our heart is our great friends at Terra Capital that have lent DK for this chat.
Yeah, we should be paying them
Bondi
for access to Dylan, I reckon.
Yeah, don't give them any ideas. But great supporters of the show and great gurus in the resource investing space, and also our foundation sponsor of Anytime Exploration Services. Anytime, anywhere, anything exploration. Seamus Murphy is your man. Beauty, let's get into it. Rare Earth Spectacular. This was sensational. Can't wait for you, the listener, to get to listen to it. Here we go, Money Miners. Right, Money Miners, the much awaited Rare Earth Spectacular from my third bromance, the man himself from Terra Capital, DK Dylan Kelly. DK, welcome to Money of Mine, mate. But this has been in high anticipation, Cobber.
Thank you very much, gents. Long-time listener, first-time caller.
DK, mate, before we get into it, mate, tell us how, we won't go into your whole life, as interesting as it would be, Cobber, but, mate, your passion and knowledge for rare earths, where did it come about, and would you class it as your niche or just one of many?
I would describe my relationship with rare earths as being, I'm the unfortunate sod that rolled down one of the biggest rabbit holes you can find in the commodity complex. I hit rock bottom and kept on digging, and still found it interesting.
You must have been a tin baron first, and then when you were so just hating on life, you became a rare earths fan instead. Is that how it happened, DK?
I think I got on the bandwagon in 08 with Lynas.
Oh, geez, too early, mate.
Geez.
When you're too early, you're wrong.
way too early. So, yeah. Let's go through the first cycle. I learned a lot on both the up and the downside in terms of that cycle, which was a particularly wild ride.
Yeah.
And learned a few things along the way. But when you start putting through the lens through sort of an investment proposal and trying to come up with a thesis, it's more based on looking at the assets hard, going around the world, kicking the tires on these different processing plants, speaking with different customers, actual consumers of the material. You get a very different sense of what makes this business special and what makes it tick. I've been lucky enough to have a lot of clients when I was on the sell side, effectively enabling me to go around parts of China and parts of the US, looking at these things in quite a bit of detail. And as fascinating as it is, it's incredibly difficult to make money out of.
DK, I'm keen to hear you. So you touched on you getting interested in the sector in 2008. What are the biggest differences that you see from 2008 to now? And, I dare say there's quite a few things that look quite similar as well.
I mean, let's face it, the market's matured a lot over 10 years. We've got new entrants, less of a concentration risk in terms of the supply dynamics going on. Japan effectively underpinned Lynas and its development to get into production. It's now cranking out large volumes of material and doing so quite profitably. I think what's changed in this environment is that we've got prices coming off quite rapidly, off what is effectively a 2-year cycle where we just had a fair degree of supply disruption. And what's different this time is that we've got a very strong underlying demand thematic in terms of electrification going into these rare earth magnets known as NdFeB, that effectively all the most electric vehicles and a lot of wind turbines are effectively utilising. And that market's growing quite strong. And seeing a huge amount of installed capacity growing in most parts of China over the last couple of years, coming to a head when supply was disrupted coming out of Myanmar. So the market's quite interesting. I think the difference now is that we've got a lot of juniors in the space that are trying to inch their projects into development at a time when prices are receding. Obviously, that causes a bit of a pinch in terms of the ability to attract capital and finance them and get them up and running. I think what's also interesting is that you've got a lot of heat in the market, and that can cause a lot of disruption in terms of capital costs and execution risk with a lot of these developers. So as we've seen with Lynas yesterday, capital cost for the cracking and leaching facility in Kalgoorlie is up to 780 mil. Original budget on that was 500 mil.
I'm glad you said 780, not 730,
I was about to
mate.
say you included the OPEX, sustaining OPEX, CAPEX, or whatever bloody word they used.
Well, you have to, right? Because if you look at the development history of any project, whether it's Lynas 1.0 in Malaysia, $1 billion in investing cash flow, but then there's another further 400 million in terms of negative operating cash flow for the period. So net, 1.5 billion sunk in the project over a period of 8 years. You combine the two, it just makes it almost unfathomable just how wrong projects can go.
DK, you touched on the growth story there being centered around the energy transition. So obviously when it comes to rare earths, you've got the magnet use in EVs and you've got the wind turbine case. How does the growth story differ for rare earths versus something like lithium?
Great question. When you compare the intensity of use, you've got smaller magnets in a wider variety of applications. So every time you see, say, an energy efficient application in a piece of technology, whether it be an air conditioner or a lift, in some instances, walkways, magnets that operate inside your vehicle. It touches on several different applications. And what we're seeing is that there's a lot of substitution going on. There's a lot of thrifting where the technology is being sort of substituted out for other forms of technology. Whereas lithium, you kind of have large scale implementation through one type of technology. So
Boys, have you noticed that every time these guys ask a question, everyone replies with "very good question"? I've only had that like twice in 4 years, I think. You wouldn't believe.
It's usually a response when the person's actually thinking of the answer. Well, I must say, DK, before we get into the real weeds, I'm very disappointed you're wearing a suit, mate. It's very antithetical to the Money of Mine crew, but I'm sure the listeners now know that you're an authority figure because you are wearing a suit. But I think the real reason you're a credible voice in this space is that long duration of interest you've had here and the works. You actually sent us a meme in the lead up to this episode. I think we'll flash that one up on screen. I think it's a brilliant meme. It did the rounds on Mintwit, I reckon, about a month ago. This meme, and it's choose your mining industry guy, and it's 9 different images of different types of personalities in the mining industry. What their sort of pitfalls might be. The very first character in this meme is that Rare Earths knows it will never get built. Giant brain. So, mate. I want to ask you first and foremost, before we really go into the weeds of this market, why is it so bloody hard to build a new rare earths project and finance it and make it commercial? Why is that so challenging?
DK might be one of the few people that can answer this in the world, I think.
he is this giant brain in the first.
Let's face it. So I'd push back on being some sort of nominated expert in the field. All I can share is really some observations I can make about the industry from an equity perspective or capital markets perspective. There is no real expertise in the space. Anyone that says they are, I think, is perhaps misguided in terms of their knowledge and authority. Like, this is an incredible niche within a niche of chemical engineering that very few individuals actually have the expertise, have actually built a mine, financed it, got it up and running. I think if you look across the world outside of China, there's only one company that's done that in the last 10 years, and that's Lynas. That expertise in that group is incredibly tight-knit and incredibly experienced in terms of getting these plants to operate. So I'd think to say that there's expertise out there is, I'd say it's an incredibly limited pool and very much concentrated within the hands of one listed equity or one listed entity.
Is there, and you obviously, I think I've mentioned it before, is there significant parallels between, I guess, Lynas and a Greenbushes? So it's always that big flagship high grade. I know there's the American one as well, but is that how you'd compare Lynas if you're going to compare rare earths to lithium?
Yeah, Lynas isn't a bad comparison. So you've got a resource that's relatively high grade, single digits TREO, so total rare earth oxide, versus processing a monazite ore, and you've got a bastnasite ore at Mountain Pass in California, run by MP Materials. That's sitting at about 5% or slightly lower. So those are your two main assets. The main asset that you really have to worry about is in Baotao in Mongolia and China. That's the single largest operation in the world. That's pumping out probably about 60% of the world's rare earth oxide in one way, shape, or form, and that's a byproduct of a low-grade magnetite mine.
Right, this might be a good opportunity to for the money miners, because this is going to be a very in-depth chat to, I guess, give away a bit of how we're going to format this and how we're going to approach this interview and what we can expect. Mostly because I've been setting up and I haven't read the show notes. So, JD and Trav, so I don't cut yous off. How are we going to attack this big rare earth spectacular?
I think there's plenty of different angles we want to go. Firstly, a rare earths 101. What is it all about? Obviously, there's a bunch of different elements. What are the ones to look out for and what's important? I'm going to touch on ionic clays. They've been talk of the town lately. Then get into a bit of met, and because that's really what matters in a lot of these cases. And then look at where the value capture is along that chain.
Then we're going to talk about, we want to ask questions about the geopolitical dynamics underpinning
China.
This market. And I think at the end, once we kind of talk about the market to the end point, DK, we're going to ask you about the stocks.
Yeah, I think all those sort of questions will frame up nicely how we, I'm going to be learning along the way, can think about the various stocks out there, the various names we talk about on the show, what to look out for, what are the red flags and such. So I think that's the sort of structure.
I hope you got 2 hours spare, DK. Right.
So long as you can chop and change it and make a cohesive narrative around it.
I love it. Well, and look, you mentioned Lynas as a monazite, and correct me if I'm wrong, Arafura, they're a monazite as well. We hear monazite, we hear carbonatites, then there's the clay rare earths. I think probably a good place to start with the 101 would be to, I guess, describe these different deposits. Who's got who? What's better? What's worse? What are the limitations? I guess.
Okay, so the first thing you need to keep in mind is that rare earths aren't in fact rare. It's just a misnomer.
Did it mean rarely mined? I heard that once.
I think that the naming of the lanthanide series, back in the 1800s, gave it a very obscure sort of meaning of the word rare. That's pushed it in a certain direction that at the time had a very different meaning. All you need to know is that this stuff is relatively extremely abundant. If you put it all together, all the different elements, it's about as abundant as vanadium, sitting about a concentration in the Earth's crust of about 230 parts per million. If you strip out the individual elements, the individual concentrations aren't as much, but typically all the 12 lanthanides are actually found together in the one host material. The key thing you need to know about these elements is that yes, they're individual commodities with very different supply-demand dynamics sitting within it, but 90% of the value is all concentrated in just 2 of these elements. That's neodymium and praseodymium. Chemical symbol for that is Nd and Pr. So we tend to refer to most projects based on what the concentration is of that as an individual element. The value of that is around about $60 a kilo at spot prices. And typically you find projects have somewhere between 15 to 20% of the resource concentrated on that type of material.
And where was NdPr prices sitting when Lynas first started?
So if you go back pre-2008, average price then was sitting somewhere around $20 to $35 a kilo. I've got a historic price series going back to the 60s that you can see the evolution of it. But effectively, the average price over the last 15 years has been just sub $40 a kilo, excluding VAT. Chinese VAT.
So it's interesting because we talked about Lynas yesterday, and Amanda Lacaze made the comment that they don't need to sell this product at $60. They're starting to stockpile it, and she said so long gone are the days of August 2016 when we were forced to sell it at $29 a kilo. So times have kind of changed, and we had those big spikes in NdPr around 2010 to 12. Correct me if I'm wrong, DK. And then last year we had a big price spike again. On what you said earlier there, DK, on focusing on the commodities that matter, I think we had an interview with Kingsley Jones, and he really honed this detail into us. You got to look at how big the actual market is, because some of them just don't matter. So beyond NdPr, are there other rare earths that stand out to you that you think are valid to look into and potentially commercialize for miners?
So the other 2 that are of interest are more of the heavy variety, dysprosium and terbium, Dy and Tb. They're quite important. They're worth over $150 a kilo between the 2. Dy being a little bit more abundant than the other. Effectively, if you want high performance magnets, the addition of that into the mix is quite important. So for offshore wind turbines of a certain variety, you need certainly larger volumes of that material moved into it.
And those heavy rare earths, they're still contained in the whole ore body, aren't they? It's all just varying percentages per deposit?
Correct. So the way to think about it in terms of the value chain, you dig it up, you concentrate it. Concentrate on the open market's worth about, let's call it $5 a kilo at the moment. You crack it, you separate it. You crack it, leach it, put it into solution of mixed carbonate. That's currently worth on the open market around about $6 a kilo. But the real uplift you get is separating the individual elements from one another. So Lynas for FY23, they sold their price for about $30 a kilo across the whole product suite. And the reason for that is, and where all the economic rent is the separating of these individual elements into their own unique oxides or chlorides. So NdPr is trading for about $60 a kilo. It represents about 30% of the volume in terms of what they're actually cranking out. But there's 95% of the value in terms of total revenue coming from that one element. Just as an aside, the elements are actually warning you about the complexity in terms of separating it. Like the name for dysprosium, dy, it comes from the Greek word for hard to get.
Or please dispose of.
Please dispose of. Because the guy who originally isolated it had to put it through so many circuits. It just took him so much effort. He's just like, oh my God, like how hard can it possibly get? It can get really freaking hard. So, and just as I don't know if this is worth mentioning, but the separation of these things shouldn't be underestimated in terms of chemical complexity. Like if you go through the history of the technology to evolve this, it came out of the Manhattan Project.
Oh wow!
I mean, it's like advanced ion exchange and solvent extraction. I haven't exactly figured out exactly which parts relate to the Manhattan Project because you come to a bit of a roadblock in terms of the history. But it's a fascinating point in time, and to get it into its isolated elements is incredibly difficult. So think about Lynas 1.0 trying to create separated oxides. $1.5 billion in 10 years is almost like a mammoth sort of undertaking that has to be sanctioned by a state to operate.
DK, I'm fascinated by what you said there about moving from concentrate to mixed carbonate. The prices you quoted, $5 and then $6. So that, relatively minimal value capture is ultimately what Lynas has had to go and do is build the facility in Kalgoorlie just for that step, right?
Correct. Well, most of the magic's going to be happening in Malaysia still, with the ion exchange and effectively solvent extraction stages. They've got several trains sitting in Malaysia to do the final separation in the individual elements. The cracking and leaching is also quite important, though.
So that $1 of extra capture, obviously they had a bit of a gun to their head. They weren't, like by the Malaysian government, allowed to do it anymore in Malaysia, but $780 million to build that facility to capture $1 extra per kilo in today's prices is not so compelling on the surface.
Not so compelling, and you also have to take into account if you were to sell that in the open market, there'd be significant payability deductions sitting on top of that. So the concentrate, you're probably only getting paid 30 to 40% of the contained TREO value. If you move it up to a mixed carbonate, you're probably only capturing 50 to 60% of the value within that. With the oxides, you get the full price capture and the full uplift.
Are they realising, so any lift in the spot price, how does the market work? Are they realising any appreciation in the spot price immediately, or the offtakes are locked into some portion? How does this rare earth market work?
So the market's incredibly opaque and small. It's only around 45,000 tonnes a year. That's just NdPr in isolation. It's concentrated between 85% of the market's currently sitting within domestic Chinese production, with a small amount being traded and processed from Myanmar across the border, and raw materials of monazite stockpiles being treated in certain separation plants across most of China. So China has got the whole market effectively dominated, and the market is incredibly thinly traded. Effectively, we're observing, cargoes of a single ton being exchanged, being observed as being, what is effectively the spot price, which is really inefficient commodity, and not necessarily something that you can have that much confidence in, its liquidity or its tradability.
DK, before we dig into China, because that's a whole nother discussion, I want to hone in what Matty was touching on earlier with ionic clays versus hard rock assets. How do they differ in your mind? How do you think about them?
Okay, so...
One's hard, one's easy?
One...
Or not as hard?
the way I like to think about clays is it's a potential disruptor. Like right now, let's call it 12% of Chinese production is coming from ionic clays, according to their annual production quota series. So in certain parts or swathes of southern China and across the border into Myanmar, you get 5 to 10 meters of clay effectively sitting at surface. That's endowed something in the order of 1,000 ppm TREO contained. Average cutoff grade seems to be something in the order of about 500 ppm. So huge volumes of material were mined in southern China throughout the 80s and the 90s in increasing scale. And it just caused an ecological catastrophe because they were using effectively in situ leaching of ammonium nitrate, throwing buckets of acids on hillsides effectively and collecting it in tarps and buckets at the bottom end.
Oh, so that is true. That's what I heard. It was as simple as that.
It was as simple as that, and just due to the fact that the recoveries from that process can actually be quite high against a low head grade, you can recover economically volumes of material with relatively simple, very low mechanized versions of processing.
And clearly, the world thinks a bit differently about the environmental impact of processing these materials now. So that was, kind of an early evolution of mining this. Like what's changed since then in the way that both China and the broader world sort of think about extracting these elements, DK?
So the way to think about it, I mentioned the term disruption before. If you think about the the amount of stages that most flow sheets look like for the hard rock material, you're sitting north of over 100 different individual circuits. It's quite complex, quite binary. By comparison, clays typically attract no more than 3, possibly 4 circuits to run through, primarily via ammonium nitrate leaching and in situ recovery. So just that alone means that the process is incredibly capital light and incredibly operating cost efficient. So the ability to get these plants up and running hasn't necessarily been done out of China before. There's one project in Brazil at the moment called Serra Verde. It's effectively owned by Vision Blue. It's a bit opaque in terms of how they're producing, but they've currently got a plant under construction. If that gets up and running, that's going to be a huge sort of high watermark function for the development of this technology and being deployed more broadly, just due to the capital intensity being so low. Like you can get the feasibility study for other projects in the world sits at about 120 million US, with operating costs of about $13 a ton. So it's relatively rudimentary. It's scalable. And if you can get the high recoveries associated with the test work, you can really make a meaningful dent in terms of the market penetration relatively rapidly.
And is there a lot of confidence out there in the market now that this capital light method for the clays can be done in a environmentally friendly manner today? Well,
let's face it, if we're talking about in situ recovery, obviously that's not necessarily going to be going down too well with the locals. So I'm sure if you had leach pads set up or column leaching, that type of variety, I think would negate most of the issues associated with the downside of runoff that you get from most of the reagents going into the ore.
Okay, so I read a note that you flicked over. You'd written a few years ago, and you really highlighted the barriers to entry across the whole rare earth complex. Have there been material changes in these barriers to entry since you writing that note, I think 5 odd years ago?
So the barriers to entry couldn't be any more stark in this. It's almost like something out of Lord of the Rings and the Battle of Mordor. You've just got a massive barrier, massive moat, enormous castle turrets separating pretty much any junior from actually entering into the market. You need at least $1.5 billion Australian dollars in 10 years to get this over, to get a project up and running. And there is little to no guarantee of success in a lot of those instances. Mountain Pass failed after 1.6 billion being sunk into it in 6 years. Lynas was 10 years till it was actually economically profitable. Thinking like a junior, if you're going to go full vertical integration and separate, which means going from concentrate to carbonate to a separated oxide, is incredibly challenging. So the advice I was trying to lament to a lot of juniors over the last few years has been, don't go vertically integrate. It's just far too hard. Try to find a shortcut utilizing existing capacity with the incumbents to actually separate this material.
Those figures, sorry, DK, those figures like 1.6 billion for MP, is that to be fully integrated, vertically integrated?
So that was under its first iteration under Molycorp, going back about 10 years ago now, and that was the 6-year process to which they never actually managed to get the material into solution, and effectively filed for Chapter 11 before it actually even started generating any saleable product. So you'd say that the incremental capital to get to the next point, I think at this point is sitting at around 450 million US.
The thing that might be different since you wrote that note, DK, is the willingness of governments and to ultimately underwrite that capital by way of some low cost, long tenor loan, and then throughout a duration of potential ramp up issues, they're going to be flexible financiers if you're having issues when it comes to repayments because they're governments.
Correct. So I mentioned before, this is such a hard, complex task to undertake. It came out of the Manhattan Project. It needs almost like a state-like implicit backer in the process. So Lynas had Japan and JOGMEC effectively underwriting it with the most carefree sort of terms and conditions placed upon the facility that they ran. They still get effectively a free kick in terms of some of the interest payments sitting within the existing stack. You look elsewhere, like Iluka's got the Australian government with the backing of almost the implied backing of the US for 1.2 billion Australian to build up at its plant in Yeba.
Amazing. $1.25 billion long tenor, low cost, non-recourse loan is unheard of.
It is unheard of, but that's the type of backing you need to get these sort of projects up. And even then, there's still potential complexity in terms of ramp up. The ability to achieve that initial capex number seems effectively undercooked in terms of what it could potentially blow out to.
Well, while we're on the clays a bit still, DK, what determines the good versus the bad clays? I've heard, commentary about meteoric being sort of the standout at the moment that requires the highest pH to get the metallurgy going, and then other competitors in the industry that require a very, very low pH, which means a shitload of acid to make it work. What is all that a function of? What makes, and look, correct me if I'm wrong if there's other standouts, but what, like meteoric, and what makes that, the deposit that is going to be the easiest to process?
Okay, so you look at the textbook. Textbook doesn't even talk about ionic clays at all. It's a process and a technology that seems to be in the hands of a handful of state-owned Chinese enterprises in southern China. So the flow sheet, we're really scratching at the surface in terms of understanding how it effectively works. But in its essence, what makes a good versus a bad ionic clay? So we're talking about rapid leach times and leach cycles, where the recovery or total recovery of materials is relatively unchanged versus 5 minutes versus 60 minutes versus 24 in terms of rapid recovery times. You're talking about relatively easy precipitation of the solution into a carbonate product. You're talking about I think the third and final one was a relatively high pH. Or effectively neutral pH to effectively recover it in solution.
And is there anything that's identified prior to, the MET testing, or is the MET testing is what determined this, or is there anything in the mineralogy that identifies what clays are going to be easy and what clays are going to be difficult?
At this point, the only thing we can go on is the MET test work and effectively a specialist test work that comes out of ANSTO, or the CSIRO lab in Sydney, that specialises in this type of resource. So there's other groups out there that can test in parts of Germany and in the US that also are familiar with this type of mineralisation. But if ANSTO, that's my personal check in terms of understanding, have they actually green lit the project in terms of affirming it is in fact the real McCoy as being an ionic clay.
DK, I want to take a step back for a second. We're always sort of analysing risk versus reward. And after 20 or 30 minutes in this discussion, this seems incredibly hard. There's only a few companies in history that have got to the end point and are reaping the rewards. How does rare earths not just go into the too hard pile?
I think in a lot of instances, that's what I've been trying to say for a long period of time. This is a commodity that is incredibly difficult to make money out of. There are far easier ways to make money in this game. But if you're prepared to actually have a good hard look, there is opportunities, but only in the right setting and circumstances. As I said before, the potential for ionic clays from the likes of Meteoric or MEI seems like a pretty high probability that it could upend the conventional hard rock mining method and processing method. So from my perspective, pursuing those types of opportunities from an early stage where you've got visibility on MET test work seems to be one of the few opportunities that you could pursue. But there's other ways that you could simplify, right? We're talking here before about the 3 processing stages: concentrate, carbonate to a separated oxide. Some producers are going down the route of only producing a mixed carbonate. So Hastings, HAS, is going through that process at the moment. I'll try to build a project, Yangibana up near Geraldton. That's only going part of the way down that risk and profile curve.
It's a revised strategy from them to lower the upfront capital.
They got hammered for it too.
Yeah.
Correct, they got absolutely hammered for it. But now they're only talking about producing a concentrate. So only one stage down that value path, and then finding someone to do the remaining recovery work down the end. Now that seems like, relative to the risk, a far more attractive risk-reward profile.
Especially when there's a refinery that's going to be built in WA, which probably has capacity.
Correct. So you'd say that the likes of, say, Northern Minerals, NTU, they're trying to just shift their project from being sort of a downstream mixed carbonate to possibly separated oxides of more the heavy variety, to just shipping to Iluka, just a rare earth concentrate, straight to Enieba. So in that process, you've got a lower capex profile, lower opex, but you're giving away quite a lot of the economics to Iluka in that process, just via the trouble involved in recovering it.
You mentioned Northern Minerals there, and that kind of is a good segue into China, because FIRB recently stopped I think a 19.9% buy-in from a Chinese-backed group into Northern Minerals. I want to hear how you think about the dynamic between China and the rest of the world, given that we can do all this separation facilities, but the ultimate product still needs to get sent to China, right, to be turned into an end-use product, unless you're, of course, Lynas, which takes out most of Japan's need for rare earths.
So China's got the stranglehold over, let's call it 90% of the market of both heavy and light rare earths. And in terms of the downstream IP, in terms of refining from, say, an oxide to a metal, they've almost got 95% or 100% coverage of that market. So in the current instance, if you're producing a mixed rare earth carbonate, there's very few producers outside of China or processors that can effectively toll treat your material to effectively get the separated oxides. So producers and potential developers here are effectively hamstrung in the fact that they've only got a handful of Chinese customers that can A, take it, and B, pay for it. And that effectively snookers a lot of the strategic value that you can have in developing a rare earth project, which is supposed to be competing with the supply chain of China. So the downstream being tied up in the way that it is creates a lot of problems, and it means that there's very limited flexibility in both economic terms to toll treat some of this more sort of raw material in the early stages of development. So financiers have got problems with how rapidly the likes of, say, Lynas and Iluka can get up and running, or Neo Performance Materials, which is like a TSX listed separator and magnet manufacturer based out of Toronto.
Yeah, Luca Gicavazzi talked about them when we interviewed Wailu, and I can't stop thinking about his one comment that he made about rare earth. He said rare earths are a bit like pixie dust. They just make everything better.
Yeah,
imagine if he worked at Iluka. It could be Iluka Gicavazzi.
Pixie dust, the world's vitamins. We only need it in tiny trace elements in order to function. I think that would be a bad way to think about it. But Jerry, you're exactly right. But there's just a lack of infrastructure right now for most producers to sell into a Western developed market. I think what Iluka and Lynas are trying to do in terms of opening up the ability to treat third-party material opens up a potential sort of new revenue stream and a new market for developers if they're prepared to share in the economics.
So what do you make of the government policy around this? Do you think it's short-sighted or uneducated, or you think they don't have a choice? It's the only thing they can really do?
Well, everyone's very excited about all things strategic or critical minerals without necessarily understanding the underlying fundamentals of how the supply chain works. So demanding that we're somehow going to have downstream separation and refined metal and magnet manufacturing in parts of the US and Australia is, I think, probably a bridge too far. Australia is the world's quarry. We're not very good at value adding. Trying to force a government solution to developing such infrastructure, I think, is incredibly arrogant relative to the complexity of actually achieving it. So in my mind, the way that the government's effectively funded Iluka sets a pretty good precedent, and to a certain degree, what the US Department of Defense has done with Lynas is to effectively back the incumbents, back the existing producers that have the capacity to actually build these things and not only build it, operate it profitably, to ensure that they can actually get the end product or the raw material product produced in the first place, and somehow fund that with a low recourse loan is I think perhaps the only way that this is going to happen with a state backing.
So given that a lot of the value capture is then in China, and as you put it, Australia is the world's quarry, would Terra actually ever look at investing in some of these Chinese listed players?
I think we would be prepared to look at some of these Chinese players. Our mandate's global, so we can jump into any sort of listed vehicle. I think because of the way in which the market is currently structured and the opaque nature of how some of the Chinese entities operate, we could probably see far more attractive names and liquidity elsewhere in the likes of, say, a Neo Performance Materials or an MP Materials based out of the US. The need to go downstream into the likes of, say, a Shenghe, China Northern, attracts a whole bunch of governance issues and effectively the E and ESG hurdles for us.
Dylan, you talked about Iluka's refinery that they're developing at Eneabba a bit, and we'll go into that in a bit more detail and what that means for the other developers in WA and Australia. But before we do, I just want to touch on, like, Iluka, they're building this refinery because they've been stockpiling a byproduct from their mineral sands processing at Eneabba for a long period of time. And it appears as someone following these markets that this byproduct that comes from a mineral sands processing perspective is sort of becoming more and more talked about as a way to capture value in the rare earths game. Like I'm just curious, how does that actually come about? And B, are you actually looking at mineral sands names as potential ways to get some rare earth optionality now as well as an investor?
I'll say first, fuck, that's a good question, Trav. These boys, fuck, they're good.
So I think the first part of your question is to do with price and in the incentive price that we've seen over the last 2 years. So price of NdPr or a basket of goods in stockpile monazite concentrate or thorium concentrate attracts about a price of around $6 a kilo over the last 18 months. And you've seen stockpiles of any type of old mineral sands operations effectively coming forth quite rapidly as prices are being just that high enough to incentivize the production of or the recovery of those old tailings dams or those old tailings stockpiles to be thrown in the back of a container and shipped into certain parts of southern China for further separation. As prices have started to ease over the last, let's call it 6 months, the flow of that material has slowly subsided. And I think there's going to be further pressure on that market just because we've already seen in the spot price of monazite to be slowly falling back below that $5 a kilo range. So does that answer the first part of your question? Your second part was?
Yeah, I guess I'm kind of curious. Like, so the rare earth elements are basically they're found. They kind of occur in these mineralized ways that are often found with these mineral sands. So is that my? I'm not a geologist. I don't understand this stuff. I'm just trying to figure out. They come together, right? And then a byproduct is like in this concentrate. There's a bunch of potentially recoverable rare earth elements left aside. However, in these concentrates, there are often challenges to separate them. One being that they're often radioactive stockpiles, right?
Correct. They do attract, some of these mineral sands do attract certain of the unpopular thorium and uranium that tend to contaminate certain soils. So the treatment and transportation of those products is somewhat problematic in certain jurisdictions and in certain trading patterns. Yes, it is a bit of a problem, and it does attract a bit of a discount. There are only a certain handful of separation facilities in China that are licensed to handle that type of material.
Is radioactive material present in all rare earths or just some rare earth deposits?
It's a good question. I hope you like that I mentioned that, mate. That's it.
Oh, cheers. Oh, I didn't even notice. Chuffed.
For most of the hard rock minerals, there does tend to be isolated elements sitting within somewhere in the order of 50 to 60 ppm thorium and plus uranium sitting within it. Some of the ionic clays, those sort of heavier elements have actually been washed away and doesn't necessarily come along for the ride. So it's relatively clean in terms of that process.
Is that because it's close to surface weathering? Is that the reason for it?
Part of the weathering process effectively gets rid of some of the heavier elements, and it's effectively cleaned up for the most part. But there is still trace elements in there. Although there is one former rare earths mine, which is actually a thorium mine owned by Anglo American in South Africa. It's currently grading somewhere north of about 30% TREO and about 10,000 ppm thorium, I believe.
Jeez.
So, very, very high grade, but how do you actually clean up with a lot of those nasties is, I think I need a chemical engineer to actually understand that.
DK, I've got another question on China, which I'm really interested to get your thoughts on. So the Chinese government, one of the departments, puts out quotas on mining and on refining. How do you think about that impact on the market price of NdPr predominantly?
Okay, so if you look at the last 3 years in aggregate, the government departments that effectively put out these quotas every 6 months have been increasing at about 15-16% a year. And these quotas are strictly enforced. Go back 10 years ago, it was the enforcement was very light. But due to the effectively environmental externalities of processing a lot of this material, particularly in the southern ionic clays, there's been a very big cleanup in terms of license capacity and only certain institutions being effectively given the green light to process, and they're strictly enforced to a certain degree. although very uniquely, a lot of the capacity that's come out of the market. Let's go back 5 years ago. 8 years ago, there's probably 350,000 tons of separation capacity of a TREO variety, and that's now fallen probably to less than 150,000 tons. And the licensed capacity annually now is sitting something in the order of like 120,000 tons. What can be made up for, though, interestingly, is the use of imported material rather than domestic forms of feedstock can circumvent a lot of the regulations or those quotas. So that's why we've seen a very large amount of material coming out of places like Myanmar in the southern provinces of China, where effectively the miners have moved just a long strike and across a geographic border into another jurisdiction, and are effectively just trucking over raw feedstock, circumventing a lot of those rules.
Okay, so there's another commodity we've touched on quite a bit on Money and Mine, and that's cobalt. And how that relates to this story, in my opinion, is that a lot of Western companies didn't want cobalt to be a part of their batteries going forward because it wasn't checking the ESG boxes. And what you're talking to there with China, it sounds like, not checking many ESG boxes. So we heard about half a year ago, Tesla saying they want to develop some sort of battery with a magnet, like a permanent magnet that doesn't involve rare earths. Do you think there's any real weight to the risk over the medium to long term of, this a substitution effect for a lot of these commodities?
There is. Famously, a consumer or a manufacturer of wind turbines stood up at the Rare Earth Conference and said that at $90 a kilo NdPr, that they would be substituting away the technology and moving into something else. So there was effectively like a notional sort of price ceiling for consumers where wholesale substitution could exist. Now, what that means is effectively a trade-off from the OEM's perspective into another technology that may or may not be as efficient. In the case of, say, permanent magnet motors, PM, SM motors that utilize rare earths, you can substitute into a type of ferrite magnet or a samarium cobalt magnet. However, the trade-off is that there's like a power loss, or you have to take on a far larger type of magnet in order to get the same sort of performance. And the offsetting function of that is, in an electric vehicle, you might have to end up using require more battery packs to effectively change the power ratio moving into the vehicle.
So an NdPr magnet, it's 20% more efficient than your standard magnets. Is that the number?
So the actual percentage difference, it doesn't necessarily work in terms of percentage difference on one single metric. So we're talking about NdPr going into an NdFeB magnet, and the NdFeB magnet being a far more efficient, high-performance function for certain types of permanent magnet motors that utilize that technology. And you can shift the magnet, you can trade off to other different types of magnet technology. So Toyota, for example, uses a completely different technology in its hybrids and some of its platforms, and actually promote the fact that they don't actually have, they use the La and Ce, or the lanthanum and cerium rare earths in it, rather than some of the NdPr or even the Dy and Tb elements within it. But to change that requires a completely different technology, and there's typically a larger trade-off in terms of power.
So as the market currently stands, I've read that there's pretty limited recycling and reusing of these commodities in batteries and magnets and the like. Do you see there being a bigger future for recycling?
Look, the recycling part of it, it's already a very large part of the existing market. So when you convert from an NdPr oxide into an NdPr metal, and then convert that metal into the magnets themselves, There's a large amount of wastage in terms of the cutting that comes away from the material that has to be recycled back in from an oxide or a metal form. So recycling in China can be, I think the last time I saw the number, probably not best to quote me on it, but was something in the order of like 8,000 tonnes out of a 45,000 tonne market. So you need to think about that in the first instance about the recycling. At the moment, I think what we're talking about here is in the next generation of vehicles, when there's sufficient feedstock in terms of the number of cars that are running around with this technology in it, is there going to be a large amount of recycling? You betcha. But it's going to be a long time before you see wholesale volumes of recycled material coming up. There's an interesting business in Texas called Urban Mining, who are recovering or trying to recycle effectively the Nd and the Pr from permanent magnet motors in vehicles, and I think they're going actually along pretty well. But the recovery, the intermingling of all the different elements is quite problematic for recovering in pure, high purity material. And I think that's where a lot of the economic case for the recycling breaks down.
DK, let's pivot to stocks. We're now market experts, so I thank you for that. But to sort of frame, I guess, the discussion of the universe of companies that have a project out there, you kind of alluded to there's a special set of criteria that actually make something investable. What's the special kind of the Goldilocks situation you sort of need in order to actually think that like any one ticker is actually investable?
So in the first instance the first rule is back the incumbents, back the existing producers, because the barriers to entry are so high, and they deserve a premium because of the amount of effort and energy gone into getting this thing up and running. So the Lynases, the Neo Performance Materials, the MP materials to a certain degree have effectively tick all those boxes. So investors in the first instance, you're better off looking for a generalist investor, sticking to those larger cap names. If we delve into the criteria or the checklist that we operate under, the first instance is you need to have the explicit state backing in terms of a large, low cost, low recourse debt facility to back it. So Lynas had Japan, Hastings had the Germans, Iluka's got Australia and the US in its corner. That's the sort of backing that you need, because equity investors have to have that sort of formidable sort of debt piece backstopping it when they get into trouble. The third criteria I'd be splaying down is NdPr is going to be the primary product, and it's got to be highly concentrated in NdPr. So a lot of analysis goes into what is the mix or the assemblage of all the different lanthanides in the list. Effectively, the concentration of NdPr above, or the industry average is about 16%. You need to be really pushing beyond 20 to 25% NdPr to have a really high grade, high value sort of NSR material that's going to be sellable. I think the fourth criteria, which is a bit of an odd one, is going to be more or less looking into the disruptive technology around ionic clays. So if you've got a project that effectively ticks all the boxes in terms of being the real McCoy, has relatively high grades and high NSR concentrations, has been significantly de-risked in terms of metallurgical test work, then you've got perhaps a project that works. What do we want to see in terms of met test work? Look, if you're going to spend $1 billion on developing a new mine, I think I want to see at least 2 years worth of test work and $100 million spent on full simulation, piloting, operating to ensure that the process works.
Geez, that's big. That's big. Pre-processing capital, isn't it? When you talk $100 million,
might cut the universe right down, I reckon. So why don't we start with Lynas? Firstly, I mean, Lynas's story has been fleshed out quite a bit. We've obviously spoken it already, but I'm interested to hear what you think about the execution risk of Kalgoorlie.
Good question. So have you guys ever spoken about McNulty curves?
No.
No, just Lasson's.
McNulty curve is a good way to think about it. So if you plot the direction of the commissioning of any type of processing plant, time on one axis, vertical axis in terms of percentage of nameplate capacity, you'll tend to find that every processing plant follows a standard type of trajectory. If the plant is well tested using existing technology that's been used several times before, you'll find that within 12 months' time, it's operating at 100% nameplate capacity, if not even beating it. But if it's first generation technology, piss poorly tested, using methods that have been never tried before, and a new commodity, you effectively follow a trajectory that after 4 to 5 years, you're struggling to reach 30 to 40% of your nameplate capacity, and requires significant reinvestment in order to be able to make the flow sheet even work and operate. So McNulty curves are...
I'm thinking of the potash developers in WA.
McNulty curves can apply to almost everything, like at the HPAL plants that were built out for nickel back in the day were a great study. If you look at the trajectory of any sort of lithium plant in the past, it's just a really good sort of road mark, sort of a runway to actually see what trajectory these could be flying at. So when you look at Lynas 1.0 in Malaysia, say going back 10 years ago, you would say that is definitely a type 4, type 5 McNulty curve project. Very poorly tested, didn't necessarily work when they built the thing, they turned the key on and tried to get the process plant working. Nothing worked, nothing came out, and they had to rebuild the plant from there down. But over the years, they've actually built 4 cracking and leaching rotary kilns, and they've got fairly good at operating it and modifying the flow sheet to effectively work now. So what was then a type 4 McNulty, in this instance now, they're just building one giant rotary kiln. I'd say it's probably type 2, type 1. So the confidence level and the ability to execute, I'd say, is significantly reduced. How I think about this plant, though, is at times when the market is frothy in terms of prices running particularly high, there's scant available labour, there's a shortage of materials around, and EPC contractors are effectively swamped out in terms of their order books. You're going to have a hard time trying to get a project built against a pretty rushed set of numbers. So in my mind, the way to think about Kalgoorlie is that this situation was forced upon them by the Malaysian government, kicking and screaming almost, to have this facility up and running by 1 July this year. That's now been pushed out to 1st of January. But the price and the cost of this keeps on rising. Now, that's no fault of their own. I think that's largely the market, the WA market as it is right now, and the challenges that are faced trying to get these projects up. Everyone's having trouble. But trying to find the people and materials is incredibly difficult. I think ultimately they'll get there, particularly the fact that was particularly reassured by the fact that they were going to bring down a lot of the Malaysian workforce from Kuantan through the commissioning phase and through the initial operation phase. The fact that they've been doing it for several years in Malaysia with such a degree of confidence gives me some degree of comfort that it is actually going to get worked out.
DK, still on that kind of the theme of actually building one of these plants. We talked a bit about Iluka already, and when they announced FID on that Eneabba refinery, which included the giant free kick from the government, that very very lucrative non-recourse loan that was a part of it. The FID was announced, but the only real feedstock that they had for it at that point in time was the Eneabba stockpile. They spoke to the potential of being able to feed Wimmera through it. I think to date that still requires a bit more of a processing solution to actually be utilised in a refinery there. Since then, they've got a partnership with Northern Minerals. So the Eneabba refinery would account for 25,000 tonnes per annum of the 55,000 tonnes per annum nameplate. Northern Minerals probably adds 4,000 tonnes per annum, and then they're executing on a new project, Balranald, which they say is going to add another 4,000 tonnes per annum. So on my numbers, there's still 22,000 tonnes per annum of capacity to fill there at Eneabba. I guess my question to you is, like, where does this come from? What does this mean for the rare earth developers out there who might be, looking at producing a concentrate?
I think part of the support package that came from the government for that debt piece probably comes with some unwritten clauses about opening up the market to treat third-party material. I think that should be an explicit part of the incentive package to get this up and working, so that there's sufficient feedstock coming and filtering its way through to the grassroots of any sort of developer, perhaps, who wants to get the project up and running. They can consider an early sort of lower risk pathway to development. I think in most mineral sands operations, in my experience, I don't know if this is collective, but monazite does tend to be quite a large byproduct that is effectively stockpiled, or if not, put straight back in the pit as it's recovered. So the commercializing waste streams or otherwise waste streams is an easy way to effectively get some additional revenue regardless of the complexity of actually handling it or processing it yourself. I think it should be said that the latent capacity sitting within both Iluka and Lynas is somewhat glaring, and I think could unlock over time if the terms are right to bringing on a lot more developers.
So in that list of developers, the first one I want to talk about is Hastings, and we touched on their Yangibana project. And I remember following this company about 18 months ago, and at the time it really felt like they were right around the corner from announcing FID, that they'd announced some debt package and there'd be the equity raise to go along with it. It felt like super close. There was all of this sort of support. Since then, at that period of time, things stalled a little bit, and then they started talking about this mine to magnet strategy. And Wyloo came in and gave them some money for them to pick up some shares in Neo Performance Materials. And since then, the share price has drifted off a lot. They're these sort of convertible notes, which the interest is paid in more shares. And there's just been so much change at the leadership level of that company too. You had an interim CEO, Owen Vorster. He joined and left within eight months, and then you had the CFO, who I presume was tasked with the whole project finance work stream, which is a mammoth sort of work stream in a niche commodity. He left and joined a lithium developer. So how should investors sort of think about Hastings, their kind of pivot in strategy over time, and really where they are now, given that sort of turbulence?
So I think let's start with the good, and then we'll move to the bad. The good, they've got extremely high concentrations of NdPr, greater than 25%. It's one standard deviation above the mean in terms of that mix. So they get a high NSR value, or sitting at just about 1% TREO. So the ore, the mineralization upgrades relatively well, concentrates well. And they can produce a mixed rare earth carbonate, or that was the original plan. What's happened in recent they've got the funding. They've managed to do early site works at the project itself, and they're sitting with a position to effectively fund one part of the plant. What's happened in the last 18 months is that they've changed the strategy to effectively move the upstream and the downstream from site, from all being at site, to having one site effectively doing the downstream based in Onslow. And effectively the capital cost of separating the two plants has effectively grown out to around about, was it $980 million dollars. Well up on the initial capital estimates. I think it originally started, when I first looked at it, was $350 million. So the project fundamentally remains the same, but where the different parts of the flow sheet have been moved around. Right now, they've got a situation where The equity value slid so far. I think market cap's 134 million, cash of 104. So let's call it 20 million EV. The market's already pricing this into a bit of a quarter. They need to raise $400 million in debt in order to be able to fund stage one, which is just going to be the mine site producing a concentrate. I think ultimately, who knows if they're going to be able to get through the current financing situation for the debt. But I think ultimately it will be developed, whether or not this happens now or in several years now, with Wyloo taking control or potentially participating in an equity raise to effectively backstop the missing parts.
It's yeah, I mean it's a fascinating one, and I think they've still got the Neo shares as well as part of that part of that stack, which is whether that kind of there's been a bit of a change in that mine to magnet strategy in the context of the fact that they're just going to produce a con to start with. Does that concentrate actually just make more sense to just go to Iluka's refinery?
Well, Iluka's refinery, Neo Metals Silmet facility in Estonia, someone in China. It remains to be seen exactly how they're going to ultimately generate revenue from a concentrate in the near term. I mean, I think the downstream strategy has a role to play, although I've been advocating to stay away from vertical integration just due to the complexity and the capital cost associated with it. Whether or not it was the right time to go downstream into magnets, I think I question that. I'd rather see the project up and running and generating cash flow before they started to make the leap down, several leaps down to magnets, and whether or not it was the right vehicle to jump onto in terms of a listed producer.
There was another recent listing that I wanted to ask you about as well, VHM. So they've got some pretty standout numbers, an NPV of 1.5 billion, an IRR of 44%, yet they're capped at a bit over 70 million. I'm just interested to hear what the sort of catch is. There's got to be one, right?
Yep. So as I may have mentioned at the outset, rare earths aren't rare. They're relatively abundant. Average grades, so if I look at all the world's resources, there's 126 deposits out there with an average grade of about 1% TREO. Mineral sands mines will typically have this as a byproduct or a sub-byproduct sitting within it, so it should come as no surprise that there's a heavy mineral sands project with a byproduct of monazite that could be converted into NdPr oxide. So I think of VHM alongside most other mineral sands miners that have this as a byproduct. It should only be thought of as a byproduct. If it can't necessarily make the rutile TiO2 sales process as the primary product, it's probably not going to work as a standalone rare earth project to come along, because it needs to go full vertical integration down into oxides to be able to make the economics work.
That's interesting. Nonetheless, it's still attracted major project status from the Australian government. So we'll see how that one plans out. If you say you're you advocate against the vertical integration, because of the complexity in the capital, I imagine you might have a bit of an objection to Arafura and their Nolans project, given their plan is ultimately to go everything from the ore to separated oxides all at the same location, and I imagine there's a lot of complexity given all of those different processes. Am I reading you right on this one, DK?
I think, and the location's in buttfuck nowhere. That's probably a big function.
You're exactly right. Stay away from full vertical integration. I think I can see the appeal of having everything in country in Australia. So what Iluka's doing up in the west coast makes a lot of sense, and it ticks a hell of a lot of boxes in terms of its strategic value if it's all based in Australia, rather than having a dislocated supply chain passing through different countries. So I can see why they did it and understand how it's happening. I think the capital hurdle might be too much. Whether or not it should be moving part of the flow sheet to somewhere a little bit closer, like Darwin or even Alice Springs, makes a lot more sense to me. I mean, operating such complex chemical plants is difficult even in the best environments, let alone out in the middle of nowhere.
God, it'd be a bloody decent flight to get. Imagine getting a fly out of Alice Springs. That'd be one of the biggest FIFO trips going around from major cities.
Yeah.
I suppose you bang in the middle so you can go from anywhere.
Yeah. There's one other rare earth developer that never made any sense to me. I didn't have the patience to understand it, to be honest with you, because I'd look at their marketing materials and see photos of places in Korea and stuff, and I just didn't quite understand. But it was ASM, Australian Strategic Materials, and their Dubbo project. What do you make of that? I mean, you've got more patience than me. I'm sure you understand what the rationale there is, and how do you interpret that?
So my take on ASM, if you come back to the third criteria I laid out before about NdPr being the number one product, it's the third product, I think, in the product suite. So it's primarily hafnium and I think it was niobium being the number one product. Number two, NdPr was less than 5,000 tons. Less than 3,000 tons in terms of total rare earth oxide produced. So I didn't necessarily see it as a rare earth project per se. I saw it as another sort of critical mineral suite. So it didn't necessarily come into the mix. I think they had plans to go full vertical integration as well, which adds to the capital cost. One thing that did give me cause for pause was that they alluded to the fact that they had potential debt funding coming from the Koreans. I thought that their interest in that project could have got them across the line on that second criteria about having the explicit backing of a state.
You mentioned niobium there, so I have to ask you about WA1. I also have to disclose that I own a few, but given you're such an expert on the space, I'm interested to hear what your thoughts on that really early stage discovery that they have at Looney.
Is niobium even a rare earth?
I believe so.
Good question.
We're asking the right guy.
I don't know if it's on the list of lanthanides there, but it's co-located. Look, I don't actually have anything further to add to the great work that you guys have already done in terms of having conversations around the commodity and the existing production. Although I would say I did try to benchmark it against the Canadian producer, one of the listed producers. That seemed to make a lot of sense in terms of cut-off grade, scale, and just proving the point that it can actually be produced at an economic rate, regardless of the price, which I think prices are somewhat suppressed at the moment.
And it's purely a function, the WA1 story is still very, very young. I assume that's we're waiting on a lot more info. Is that behind your thesis, DK?
Yeah, met test work. Let's see what comes out.
Speaking of the earlier stage projects, DK, there's been a lot of excitement in the market about the ASX listed early stage projects which are actually based overseas. I'm talking specifically about Meteoric Resources, MEI, and also Lindian Resources. I mean, Meteoric we've talked about a bit with the Ionic angle there, and Lindian's a different one. I mean, the project was caught up in an arbitration battle for a long time. I mean, I'm pretty sure it was a project that once upon a time Lynas themselves wanted to get their hands on as well. When you go through the announcements, how are you looking at these two projects and stacking them up against each other, weighing up risk and the likes of the two and the hype around them at the moment?
Lindian, I'm less familiar with and have less of a handle on its plans and its met test work to date. I'd say my preference here is for MEI, just due to the fact that initial test work was so positive and recoveries were so strong across all those key criteria that confirms it was the real McCoy. The low capital intensity has really got my attention. If you just compare it to Makuutu with IXR and Aclara, which is Canadian listed group, and its Chilean clay project, like it's such an attractive sort of potentially lower risk development option, like $120 million US to build, $13 a ton operating cost. I think it's very hard to beat that flow sheet complexity being almost agricultural in terms of number of steps required and the potential to scale these things up. This could really turn the industry on its head in terms of hard rock conventional processing methods and high capital intensity quite rapidly if Serra Verde comes to pass.
Is the main driver of that the reagents required for that low operating cost? Specifically the acid.
Low levels of ammonium nitrate, relatively rapid cycle times, high recoveries across the suite, particularly NdPr being above 60%.
So is ammonium nitrate, is that the biggest reagent they use?
Correct.
Yeah, righto.
DK, what are the complexities around, from my understanding, meteoric, it's relatively close proximity to a historic uranium mine as well, and like what are the complexities around actually extracting the rare earth elements without the deleterious, thorium, et cetera, that we talked about before? And like, is it kind of just like understood that you can do that, or is it quite tricky?
I think it's relatively, the term keeps on coming up that it's agricultural in terms of its simplicity. As in only three, possibly 4 stages of treatment in order to get it into a mixed carbonate solution. Like that is incredibly easy. And for the most part, the weathering profile of the clays means that most of the deleterious elements have already been washed away. So I think the thorium and the uranium content is trifling small, like fractions of a gram per ton sitting within it versus say 30 to 50 of both elements sitting within most of the light sort of hard rock varieties.
So with those clays, how those ore bodies work, like once you got that clay component, the weathered clay component, is there still a hard rock deposit below that, or is it capped at that top point?
Most of the drilling that we've seen for a lot of these clays has just been auger holes that have been relatively shallow that have stopped effectively whenever they've hit hard rock. Most of the drilling to date's effectively just the topsoil and top clay that makes for easy drilling, and anything harder than that's effectively been discarded. But I mean, most of the clay deposits, if you look at the textbook about the clays in most parts of China, anywhere between outcropping at surface to half a metre of topsoil, straight into clays anywhere between 5 to 50 metres thick. I mean, you can make some pretty big ore bodies on the back of that, just rocking up on the back of any hillside.
Yeah, so it'll be a long bloody time before they get to the hard rock, if it is there.
Correct. But I mean, most of these holes tend to be effectively stopping mineralisation to begin with.
Thanks, guys.
What about Dreadnought? Haven't spoken about them yet.
Yeah, they came out with the
updated mineral resource the other day.
Been around for a bit now.
Haven't seen it.
Yeah. Any other names that we should be paying attention to, DK?
Pay attention to NTU because I think that's got the ability to commercialize something with a lower capital risk development profile. And just doing the JV with Iluka, I think that we should be paying attention to what they're doing.
Yeah.
Near term MEI, we've already mentioned. There's a host of rare earth ionic clays in parts of Brazil that are following in the coattails of MEI. I think as certain provinces open up, certain districts could open up with large resources at relatively high grades. I think we should be paying close attention to that.
Is that meteoric? Would you compare that to the rarity of getting a deposit like that, similar to, I guess, Luni in terms of niobium? It's not like a neurology play. Doesn't mean there's going to be one next door. Is it very rare to find what meteoric have found in the clay scene? I
think it's incredibly rare, and few and far between. Like whether or not it's tier 1, although I think tier 1 these days tends to be incredibly subjective. In this case, I think just
depends who's writing the announcement.
This is a tier 1 podcast, mate.
Exactly. But in this case, it's a large resource, like a couple 100 million tons at 1%. 1,000 ppm. that's pretty good to be playing with relative to the concentrations of NdPr in the mix. Others, how big it could grow. Look, they can do some extension drilling through the existing resource, but in my mind, it's already got a lot to play with. It's just a case of trying to optimize the existing mine plan that might come up at the scoping study level to understand exactly how much of that low grade could be sort of put aside and focusing on the high grade core.
Wicked. Well, I've learned shitloads,
mate.
Dylan.
What a fucking ripping chat.
Yeah,
that was,
definitely one I'll have to listen back to.
I actually can't wait to listen back to it, DK, so I can probably a couple of times to try and consume it all, mate. So that was, and we understand you're probably pretty parched now after that, talking rare earths for an hour. You'd be bloody stinging for a twoies new over there, I reckon, Colin.
Well, I hope it helps either way, gents. It's quite a complex space, but it's one that I found absolutely fascinating. I hope it sort of fills in a couple of the knowledge gaps and kind of simplifies the way to think about it.
And I think it'd be probably rude not to in the future that, this is a good introductory overview, but there's probably some niche areas that we can do some further episodes on with you, mate. We'd love to have you on anytime, and we really, really appreciate you divulging all your knowledge to us, mate. It's been absolutely sensational.
I can see the big brain in the meme now, mate. It's that's you.
Right, so
I appreciate it, guys. Please keep up the great work that you're doing, uncovering and talking about the sector that I think needs more promotion. So keep up the good work.
We
Cheers,
appreciate
DK.
it, mate. We'll let Langers and Bondi get you back to work now, mate. So, and on behalf of us as well, we really want to thank you, Terra, for supporting us and lending your time and everything you've done. So we really appreciate it, mate.
Cheers,
Great
DK.
work, fellas. Appreciate it.
See you, DK.
Thanks, mate.
Hooroo.
Righto, there we go. As I said at the start, absolutely ripping conversation about rare earths. I can't wait to listen to it again, boys.
Completely agree, mate. So much to take away from that one.
Yep, beauty. Thanks to all our partners, as always, Terra Capital, Anytime Exploration Services,
JP Search.
K-Drill and Topdrill, all bloody GCs.
Thanks a lot, guys.
Because you're a partner.
Hooroo.
GCs anyway.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.